Singaporeans, how would you like to earn 8% dividends from one of the biggest oil giants in the world without even touching a Hong Kong brokerage? Sounds impossible? Well, not anymore. Hey friends, if you're a Singaporean dividend investor, you're gonna like this one. Because today, we're talking about PetroChina SDR, listed right here on SGX under the ticker HPCD. Imagine collecting passive income from China's largest oil and gas company. And yes, you receive those sweet dividends in Singapore dollars. If you're excited already, smash that like button so more Singaporeans can discover dividend ideas like this. It really helps the channel reach folks just like you. Subscribe to Wealth for You for more income-focused investing tips. And stay till the end, because I'll break down what is an SDR, whether PetroChina is undervalued or a trap, and whether this 8% yield is sustainable. Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research or speak with a licensed financial advisor before investing. Chapter 1. What is an SDR? No, not a new cryptocurrency. SDR stands for Singapore Depository Receipt. Think of it like a wrapper. It lets you buy foreign stocks easily on SGX in Singapore dollars without needing a Hong Kong brokerage or worrying about foreign exchange. With an SDR, you get access to overseas companies, like PetroChina, still enjoy dividends, and trade just like a local stock. So yes, your Kopi money now has access to China's largest oil giant. Chapter 2. Who is PetroChina? Think of them as the capital land of Chinese oil. Massive, everywhere, and deeply embedded in the country's energy infrastructure. Here's what you need to know. They're China's largest oil and gas producer, and one of the biggest energy companies in the entire world. Listed in Hong Kong, but also available to us in Singapore on SGX, super convenient, fully integrated. They do everything: explore and drill for oil and gas, refine crude oil into products like petrol, diesel, and jet fuel, sell fuel at retail petrol stations across China, and distribute natural gas to homes, factories, and power plants. But wait, they're not just stuck in the past. PetroChina is also going green. They're actively building up renewable energy capacity, including solar farms, wind power projects, and even geothermal energy development. So yes, they're still an oil giant, but one that's slowly but surely transitioning toward a cleaner future. It's like if ExxonMobil had a green cousin who's suddenly hitting the gym and eating organic. Chapter 3. The numbers don't lie. PetroChina's latest financials. Now picture this. It's early 2025. Oil prices have cooled a little. The global economy is still adjusting to higher interest rates, and energy demand is shifting gears. Most companies would be sweating. But PetroChina? Still chill. In their first quarter 2025 results, the headline looked a bit shaky. Revenue dipped slightly to renminbi 753 billion. Why? Because oil prices softened a bit compared to last year. But here's the twist. Despite that, net profit actually rose. Yes, up 2.3% to a solid renminbi 46.8 billion. And the real star of the show? Operating cash flow, that's the real business engine, jumped a whopping 25%, hitting renminbi 139 billion. That means PetroChina is not just surviving. They're printing cash efficiently. They also kept their costs tight. Their lifting cost, which is how much it costs to extract 1 barrel of oil, dropped to just US dollars 9.76. That's super competitive in the global oil game. And if you're wondering whether they're just clinging to fossil fuels, not quite. Their renewable energy output, from wind and solar, grew an incredible 94% year-on-year. So even with the world in transition, PetroChina is still pumping cash, while planting seeds for a greener future. Chapter 4. Is PetroChina a bargain or a bubble? So now that we've seen PetroChina's strong cash flow and steady business, let's ask the million-dollar question. Is it cheap or just cheap looking? Let's break it down. First, the market cap. PetroChina is no small player. It's worth around Hong Kong dollar 1.74 trillion. That's roughly US dollar 221 billion. This is mega-cap oil territory, sitting comfortably alongside global giants like ExxonMobil and Shell. Now let's talk P/E ratio. That's how many times investors are paying for a dollar of earnings. PetroChina's P/E? About 6.8 times. That's very low, especially in today's market where tech stocks are flying at 30, 40, even 100 times earnings. Then there's the price-to-book ratio, which tells us what the market thinks the company's assets are worth. PetroChina trades at just around 1 times book value, meaning investors are paying close to the actual value of its physical assets, not some sky-high speculative multiple. And the return on equity? About 11%, a solid, steady number that says, hey, I'm not flashy, but I know how to deliver results. Put all that together, and what do we have? A stock that's profitable, efficient, and lowly priced by global standards. Many analysts look at those numbers and say, this one's undervalued. So while everyone's busy chasing hype stocks, PetroChina might just be the sleeping cash cow hiding in plain sight. Chapter 5. The Sweet Sound of Dividends. All right, time for the part that gets every income investor leaning forward. Dividends. Sweet, sweet dividends. And PetroChina doesn't disappoint. They pay out twice a year, just like how some of us wish we got our bonus. Most recently, there was a final dividend of about 27.27 Hong Kong cents, and an interim dividend before that of around 24.03 Hong Kong cents. Put them together, and you've got 51 Hong Kong cents per share, or roughly RMB 47 cents in total for the year. Now here comes the magic number. That's a dividend yield of around 8.1% at today's prices. Yes, 8.1%. In Singapore dollars, on SGX, from a Chinese oil giant. All while you're sipping kopi in Toa or chilling in Clementi. And here's what's impressive. Even through COVID-19, oil price crashes and market mood swings, PetroChina kept paying, and actually increased its dividends over the years. That tells us one thing. The business is not just profitable, it's also committed to sharing the pie with shareholders. This isn't just a payout, it's a signal. A signal of strength, consistency, and long-term value. So if you're the type who loves collecting dividends like Ong Bao's, PetroChina might just deserve a spot in your income portfolio. Chapter 6. Looking ahead. Where is PetroChina going? So now that we've seen the numbers, the value, and the dividends, what does the future look like for PetroChina? Let's zoom out for a moment. First, China still runs on oil and gas. While the world is slowly transitioning to renewables, the truth is, China remains the largest energy consumer on Earth, and it heavily relies on natural gas as a cleaner alternative to coal. And guess who's right at the heart of that transition? PetroChina. They're not just standing still, they're actively expanding. More domestic gas fields, especially in key provinces like Sichuan and Xinjiang. Deeper cost control to stay profitable even if oil prices fluctuate. And billions invested in renewables, from solar farms to wind projects and even geothermal energy. They're playing the long game, keeping their core oil and gas strong while building the next chapter of clean energy. And let's not forget, PetroChina is state-backed. It's part of the CNPC group, fully supported by the Chinese government. So in terms of staying power, this company isn't just too big to fail. It's too essential to let go. Meanwhile, globally, energy demand isn't slowing down. Even with all the EVs, data centers, and AI servers, the world still needs fuel, electricity, and reliable energy supply. And when oil prices start recovering, which they often do in cycles, PetroChina stands to benefit big. Plus, China's gradual reopening, stimulus packages, and push for energy independence could all serve as tailwinds. So what's ahead? In short, a company that's profitable today, positioned for tomorrow, and too critical to be ignored, both economically and politically. Final thoughts. Should you consider PetroChina SDR? All right, time for the big question. Should Singapore investors consider PetroChina's SDR, ticker HPCD on SGX? Let's not overcomplicate. Here's a simple gut check style checklist. Looking to diversify into China's massive energy sector? Happy to collect a dividend yield of 8% while you wait? Prefer to buy on SGX in Singapore dollars without opening a foreign brokerage? Want a business with strong cash flow and a track record longer than your CPF statement? If you're nodding yes to most of those, then hey, PetroChina SDR might deserve a closer look in your portfolio. But of course, no investment is bulletproof. Oil prices? They rise and fall like hawker food prices after inflation. China policy? Let's just say, it doesn't always follow Western playbooks. And it's still a state-owned enterprise, which means growth may not be explosive, but it tends to be steady, controlled, boringly reliable, which, let's be honest, is exactly what dividend investors like us want. If you're building a portfolio that pays you to wait, values stability over sizzle, and you appreciate getting paid twice a year in cold hard cash, then this SDR, HPCD, could be one of those rare opportunities where value meets yield, all wrapped in a local SGX package. So, food for thought, or should I say, dividends for Kopi money. If you found this video helpful, give it a thumbs up. It really helps more Singaporeans discover smart dividend ideas like this one. And don't forget to subscribe to Wealth for You for more SGX stock insights, passive income tips, and deep dives, all in plain English. I'd love to hear from you. Are you buying PetroChina SDRs, HPCD, or are you holding out for an even better yield? Thanks so much for watching. And as always, stay invested, stay patient, and let your dividends do the heavy lifting.